In this video, I'm going to talk about Flutter or Flutter Entertainment, which is listed on the FTSE 100, by giving my thoughts on the business and whether you should buy Flutter Entertainment right now. As usual, don't forget to leave your suggestions in the comment section down below for the next FTSE 100 stock, and by the end of this year, I will be talking about a US stock analysis as well, so don't forget to drop one of these to support the series. Flutter Entertainment is a sports betting and online gaming company located in the UK. They provide their services to a range of customers in Ireland, the UK, Australia and also the US, as well as internationally. They run a fair few different sectors inside their whole business, so it's worth explaining where they first started. Firstly, in 2015, Paddy Power had agreed to merge with Betfair. This was a split that combined to make Paddy Power Betfair. This had managed to make a balance between 52% of the shareholders of Paddy Power and 48% of the shareholders of Betfair. This then created Paddy Power Betfair, but then in late 2019 they looked to acquire a company that owned PokerStars, and that combined it into what you know today as Flutter Entertainment, and this finished on late May this year, which has now made Flutter Entertainment the largest worldwide online betting and gaming company. And this allows them to provide many different services such as sports betting, trading on the exchanges, also their own television channel dedicated to horse racing, and also things like online gaming such as online bingo, slots and casinos, for example. Flutter currently has 9,200 employees and a market capitalization of £20 billion. Firstly, I'm interested in how the market values Flutter Entertainment. To do this, I like to firstly look at the price to earnings ratio, in which we can see that they are currently trading at a price to earnings ratio of 138 times, which may sound ridiculously overvalued, but to me, this says that investor sentiment is higher. Therefore, the investors of Flutter Entertainment are more willing to pay more. I don't know why I'm doing a dance routine whilst doing this. More willing to pay more for less earnings of the business, which suggests to me that they are very confident on the outlooks of the company. Although with the recent pandemic, I very much suspect that this would have changed, and therefore perhaps their earnings may have taken a hit, especially because their sports betting outlets were closed for about 2 to 3 months of the year in the UK. Therefore, to avoid earnings in this metric, I'm going to look at the price to book ratio, which compares their market capitalization to their net assets. This tells me that they are currently at a ratio of 1.8 times, which is both larger than the market and also the industry, suggesting that they are currently more favorable and investors are more bullish on this company, but it also means they are far from being a value stock. And if you're interested in starting your investing today, why not grab a free share worth up to £100 when you use my link in the description down below to sign up to Trading 212. However, I'm more interested in the growth potential of this stock, and therefore I like to look at the quality of the management. Typically, I would look at things like returns on equity and returns on capital employed to get a good insight onto how well the management can create profits from their company. Although today I'm not going to be looking at these metrics. This is simply because they have recently had their merger in May 5th, and therefore their results are going to be relatively different. And even though there will be figures for this, I do not think they will accurately represent the quality of the management, especially seeing how recent this acquisition was. And whilst yes, we could look at this, it wouldn't really tell us how strong their subsidiary of PokerStars actually is. So we need to look at the interim results, which were published on August 27th. They'll give us a more effective insight into the business. Overall, the company has managed to get some impressive metrics, such as their adjusted EPS increasing by 56%. Furthermore, their sports betting has increased by 8% year on year in terms of revenue, and their online gaming has increased by 40% year on year. But I believe this was mainly held up by their newest acquisition of PokerStars, which has a very small subsidiary for sports betting, and a majority of their income is made in online gaming. As you can see, if we look deeper into Paddy Power themselves, we can see that they actually took a loss of 50% revenue this half of the year. SBG's revenue had actually increased by 32% year on year, but PokerStars had done the best by increasing on their online gaming outlet by 40% year on year. This may confuse you if you look at software or websites such as Simply Wall Street or Yahoo Finance, as it will look like their earnings have declined. However, this is due to a one-off charge. This is due to a one-off loss of money, or more or less a write-off of the money, which is roughly in the ballpark between 90 million and on their investor report suggesting as high as 160 million. And that's why their earnings are substantially decreased, which on paper would increase these price to earnings metrics, and that's why it looks like it's so high or overvalued. Regardless, they've currently got a profit margin of 3.2% and a rapidly increasing revenue growth. However, with the pandemic still ongoing and the likelihood of a second wave more prominent, it does make me concerned for many businesses in the stock market. Therefore, I'm going to look at the quality of the balance sheet, so in the off chance that this business starts to make losses, we can see how long they could survive. And when we look at the quality of Flutter Entertainment's balance sheet, it's okay. It's not good, but it's not bad either. This is because whilst their short-term assets do not outweigh their short-term liabilities or long-term liabilities, they do have a lot of long-term assets. I do believe that there are some regulations in place that mean that they have to hold a certain amount of assets so that they have liquidity in times of emergencies, and therefore their balance sheet might not look as good as it actually is. I'd like to look at their debt to equity ratio, which is only 31%, which I would consider fairly modest for a business. I think if they decrease this in future or use it to their advantage by growing just a bit more with their money, then it's in a strong spot. Whilst at the moment their cash flow does not cover this debt, I do think the cash flow will be increasing in the next few years, and it very much has already increased in the last half of the year. Furthermore, they have a cash position of £786 million, although this is massively outweighed by their overall debt of 3.6 billion, but it does at least give an insight into their debt, their balance sheet. Since they are rapidly growing their free cash flow, I very much suspect that this debt will be more manageable in the next few years. Although for the time being, they may be struggling if more lockdowns occur, which mean the shutting down of sports again. So how does this impact their dividend? In the last 20 years, they had a fantastic dividend and they were well regarded for their strong dividend payments and growth. Whilst in the last 3 years, they've not actually grown their dividend, and lately they have suspended their dividend, it was a good historical dividend payer. Furthermore, they would have typically paid in May and October each year, although whilst they did pay their final dividend in May, right in the midst of the pandemic, lately they have suspended theirs for their interim dividend. I suspect this is to bolster their cash position and just make the business more resilient so that if a second wave of the pandemic does occur, they're in a better spot. I suspect that this dividend will be resumed, maybe not this year, but perhaps the next financial year once the pandemic's behind us and we perhaps have a vaccine. As I'd mentioned, in the last 3 years, they hadn't grown their dividend, but prior to that, they had an excellent growth rate. If we look at the last 10 years, their compound annual growth rate of the dividends is 9.85%. Considering these last 3 years there was absolutely no growth, that is a very fast rate of growth and outperforms many of its competitors in the FTSE 100. Therefore, I see this as a pretty strong dividend growth stock, but perhaps a little bit cyclical. This means in times of recessions, people might be less willing to gamble as much money, and therefore they're more at the mercy of economic cycles. But if we are going to get out of this recession fairly quickly, then this will certainly be a stock to benefit. Therefore, I believe Flutter Entertainment has a good growth potential. And this is especially when combined with the relaxation of rules in the US, which I've not even mentioned. Now that gambling is going to become more prominent in the US, this certainly gives them an opportunity for growth. They are the world's largest sports betting and online gaming company, and this puts them in a very strong position to therefore take control of the US and remain the market leader. And they're going to use these competitive advantages in their future as their method of growth in the US. However, there is a risk that does put me off this stock, and that is regulators. And it isn't a great ethical business model. Whilst, as you know, I'm invested in Boohoo and therefore ethics aren't a large concern to me, the way they make money is by people losing money, and it's not the best of business models. But that's not my issue. The issue is that with regulators, and you may have seen that in the last decade there had been more prominent adverts advertising the safety and perhaps relaxation of gambling, and that it's been more seen as addiction and people should be more concerned about it, and I agree with this. But this does mean that it will be eating into their profit margins. And whilst I think this will be a very gradual change over the next 10, 20, maybe 30 years, it's something you should be considering if you're looking to buy or perhaps holding this stock in that long-term period. I suspect that as this time goes on, more rules will be put in place that restricts them from making money. And so they're going to constantly have to be innovating in order to get beyond this. And I will say that this is very much speculation on my behalf. And if they are able to keep ahead of the trend, continue growing their revenue and their bottom line, then I see this as an excellent dividend growth stock. And I do feel that these changes by the regulators will likely be at a very slow pace, meaning that in the short to medium term it could be an excellent opportunity to buy now. In the last 5 years, their dividend yield had been ranging from 1.5 to 3.5%. Furthermore, if you'd have bought this stock 5 years ago, you would have got returns of 99% with dividends reinvested, which outperforms our UK market by 5 times. Therefore, I feel it's a great stock to add to your portfolios if you're looking for a mixture of dividend income with a high dividend growth rate, but also that growth potential which they have that exposure to the US. Whilst sure, it might not be the fastest growing stock in the world, it likely will be consistently chugging along and benefiting as the market leader. Furthermore, historically, they were very reliable with their dividend payments, and what's not to say that in the next year, 2 years, they resume this and get back on track. This really could be an excellent hold, although this isn't for me. At the moment, I need to see how well this management is capable now that they've got a considerably larger company. Therefore, I'm going to be watching on the sidelines. This may mean that I personally might be missing out on the potential gains of this stock, but this does mean that I get the opportunity to analyse their management. If I think they're doing well and they resume their dividend, perhaps start growing it at a rapid rate, then this will certainly be a choice I'll be making in the future, and I may look back upon this stock and look to buy. If you're interested in my Cineworld stock analysis, then click the card at the top right of the video. Thank you for watching. I'm Osborne Foreman. Have a great weekend.